Today we are looking at two dividend stocks to buy with a 30% discount and a wide moat that Morningstar analysts are looking to buy. We're going to run through this list, and as always, for the two in particular, we're going to get to our valuation, the intrinsic value, what are acceptable buy prices given our investor margin of safety, and we're going to look at their dividend financial metrics. So as we can see, Morningstar have listed around 10 days ago their top 10 best dividend stocks to buy. We have companies like ExxonMobil, Verizon, Johnson & Johnson, PepsiCo. These are ones that we have analysed fairly recently on the channel. So in today's episode, the first dividend stock with a 30% discount we are analysing is Medtronic. Now, this company has 4-star rating in terms of the undervaluedness based on Morningstar's review. They classify it as having a wide moat with a yield of around 3.35%. And for those that don't know, the industry it is in is currently the medical devices. Now, we will run through their historical performance as well as looking at their dividend safety and some financial metrics. But let's take a quick look at what they say. Now, they believe it is currently trading at around 27% below their fair value estimate of around $112, and this is essentially a medical device maker who has key partners in the hospital customers industry. They have a diversified product portfolio as well, essentially aimed at a range of chronic diseases. Now, one thing that we will essentially go through, but they have been paying and increasing those dividends for the last 46 years, essentially 4 years away from becoming a dividend king. So how have they performed year to date? They are up around 5%, significantly underperforming the S&P 500, which is up around 26%. They are in the midpoint of their 52-week range, yield of around 3.4%. And look, if you've been holding this over the last 10 years, we can see it is pretty much roughly what you would have paid for it around 10 years ago. So very minimal movement. But what we do see is it did hit its all-time high summer 2021 at around $135. So let's take a look at the valuation and the metrics. So dividend safety score 99, it is very safe. Market cap 109 billion, we're talking about a mega cap company. Recessionary metrics, well, they increased the dividend during the 07-09 crash. Pretty much flat sales, given the average growth was around negative 12-13% for the S&P. And they pretty much had a recession return in line with the S&P's negative 55. Dividend growth, what's the story there? Well, this year was probably one of the worst increases for the company, 1.5%. It is lower than the 4% we advocate on the channel. And we can see over the last 5 years, they have been increasing this by around 8%. Last 20 years, very nice double digits, 13% on average year on year. And as we mentioned, they aren't far away from becoming a dividend king. They are currently a dividend aristocrat. Now, dividend yield theory, as always, states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation and our second sign here with the forward PE below the 5-year average. But as always, we don't look at any of these models in isolation, and we will draw our conclusions towards the end. We can see it is also currently trading below the healthcare PE at 17.6. Now, free cash flow payout, let's take a look. And always below 60% is my own personal target. Gives me faith that management can offer those double-digit increases we love to see. If you want, do go ahead and look at the earnings payout, but I have explained on many essential episodes why I tend to ignore this. So below 60%, 79 was what it was in 2023. 2024, though, it is expected to come in line, and it does make sense as to why we did see that very mediocre increase below inflation, given that high payout ratio in 2023. Free cash flow per share, it has been very inconsistent. In fact, if you looked at 2014 to 2023, it has decreased. Very inconsistent. 2024 expected to go up from the prior year, but as you can see, this isn't a company that has been able to increase their free cash flow rapidly year on year. Sales growth 3 to 4% is what we target for steady moderate growth. Now, 2023, their top line actually dropped. The last 2 years, pretty much just in line with inflation. They have struggled. We did see 2 years of double-digit increases, but that was quite some time ago. Numerically, though, if you'd like to see the numbers, they have doubled their top line over the last 10 years, 17 billion to 31.2. Shares outstanding. Now, we love it when companies return excess cash to investor pockets, but as we can see, they have diluted your position as a shareholder, with shares increasing from 1.01 billion to 1.33 in 2023. Now, ROIC, 10% or more is what I like to see. Gives me faith management are able to effectively allocate their capital. You could drop this down to 8%, but as we can see, they have struggled to hit that 10% I personally look for. 2023 at 7%. It is one that I would be on the borderline in terms of investing in. It isn't quite what I would like to see at 10% or more. However, having said that, both operating margin and both free cash flow margins are very strong for the company, well above the minimums we look for in the industry. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, remember, signals two things. Firstly, signals the balance sheet strength, and secondly, the dividend safety. We can see now why the dividend is very safe. These signal the number of years it would take the company to pay off all of their debt net of cash on hand. 2023 is 1.82. 2024 pretty much expected to be around the same, so it does look very strong. Now, in terms of the valuation for Medtronic, and as always, if you enjoy the content values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, typically, we run through each model, going through Graham's valuation, the multiples valuation model, the DDM, DCF, before getting to our intrinsic value. Today's episode will jump straight to the output tab, and as always, if you do want to grab a copy of this model, do click on that pinned comment below, where you can get to the intrinsic value and acceptable buy price of companies in your own portfolio, or even on your watch list. So we start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. As we can see here, it is a buy up to $89.50, at 15% margin of safety up to $84.50, and 20% pretty much not too far off the current trading price. So you could argue MDT is currently trading for a 20% margin of safety. Now, in terms of Wall Street, they do see upside to the current trading price at around 15%, as we can see here. So in conclusion, for Medtronic, we see around a 20% margin of safety, with Wall Street expecting the price over the next 12 months to go around to $93. But do bear in mind, when we did take a look at what essentially Morningstar was saying, they do believe that fair value estimate to be $112. So Morningstar do see the share price going up at some point to that level. So they see more upside than what Wall Street are targeting over the next 12 months. Moving on then to the second that we are taking a look at in Morningstar's 10 best dividend stocks to buy. It is one we haven't reviewed on the channel that much. It is Comcast. Now, they give it a 5-star rating, so they believe this to be incredibly undervalued. They also give it a wide moat with a current yield of 2.61%, and this is in the telecom industry. Now, they do essentially see this trading again at a 27% discount, around a $60 fair value estimate, and they do conclude that the company's Q3 results were disappointing, with the stock selling off after effectively posting customer losses that were deeper than the previous year. However, they do believe that they are well positioned to limit these losses and enjoy solid pricing power over the future. Now, this is one thing just to bear in mind, but they have also been increasing their dividends by 16% average annually, which is very, very strong. And Morningstar believes they have a very strong balance sheet, which is very positive for shareholder returns over the coming years. So let's take a look at Comcast. It is up around 24% year to date, pretty much in line with the S&P 500. It has had a good 2023. It is trading towards the mid to upper end of the 52-week range, but bear in mind Morningstar see the fair value sitting more likely at $60. It does offer a yield of 2.64%, and over the last 10 years, you would not only be up 71% without those dividends reinvested, but we can see it did hit its all-time high at around $62 in the summer of 2021. Now, when we analyze their dividend safety score, 89, very safe. Market cap, $177 billion. It's a mega cap company. Increased their dividend in the last recession, positive sales, but pretty much had a near recession return of the S&P 500. Very nice increase in January of this year, 7.4%, above inflation at 4%. Double-digit increase over the last 5 years, 13% over the last 10 years. Very positive to see the consistency in their double-digit increases to the dividend. And they have been increasing those dividends for the last 14 years. Now, dividend yield theory, we can see this sign of undervaluation, both on the dividend yield as well as the forward PE. And when we compare it to the communications sector sitting at 18.5, Comcast is significantly lower. Now, in terms of the free cash flow payout, well below not only 60% but 40% year on year. 2022 and 2023 expected to be 39%, so that is positive. I can see why that essential dividend has increased quite strongly over the last few years and will continue over the next few years. Now, free cash flow per share has more than doubled over the last 10 years, 125 to 280 in 2022, 2023 expected to increase. It hasn't been massively consistent, but it has been moving in the right direction that you want to see as an investor. Sales growth, pretty good to see, other than that COVID drop of negative 5%. Last year, around 4%, so at least keeping up in line with inflation. But do note 2023 is expected to be flat in comparison. Total sales then, they've pretty much doubled their top line, similar to Medtronic, 65 billion in 2013, 121 in 2022. And they also do quite a lot of share buybacks, as we can see here, nearly buying back 1 billion worth of shares over the last 10 years, which would make a lot of investors very happy. ROIC, what I like to see here is that consistency, that 9 to 11% year on year, 10% in 2022, 11% expected in 2023. And then we look at the margins, a lot of positives to say about this company, well above that 12% year on year on the margins, as well as the free cash flow margin above that 5% again. So it is a very, very well operated business based on the numbers that we have. In terms of the dividend safety and balance sheet strength, well, 2.71 below the 3 we look for. 2023 expected to go even lower to 2.47. So that is a lot of positive signs for Comcast. Now, one of the most important things is let's look at that valuation. And as always, if you enjoy the content, values being provided, don't forget to smash that like button. It helps this channel, lets me know you enjoy this particular type of content. And do subscribe and hit the bell button if you do want to be continually notified of these episodes. Margin of safety then, we start off with 10%. It does look like a buy up to $49. At 15%, a buy up to $46. At 20%, you are a few cents shy. So currently, similar to Medtronic, with Comcast, you are looking at a 20% margin of safety. Now, Wall Street believe over the next essential 12 months, it will go up around 15%. But don't forget, in terms of Morningstar, they see the fair value sitting more in line with around $60. So in conclusion, for Comcast, you are looking at around a 20% margin of safety, with essentially around 15% upside over the next 12 months. As always, if you enjoy the content, smash that like button, hit the subscribe and bell button, and don't forget to click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies on your watch list and companies in your own portfolio. Have a great day and happy holidays.